Well, hello everyone. It is Friday, December the 3rd, 2021. I am Dale Delbridge, Benchmark Realty, Murfreesboro, Tennessee. This is your status chat for this week. Now on tap for this weekend, if you keep up with NCAAF, we have the SEC Championship between the Georgia Bulldogs and the Alabama Crimson Tide. And if you're a Bama hater, this may be your week. But if Alabama plays 4 full quarters, we may have us a game. Now, if Bama were to win this game, that we might likely see Alabama and Georgia, each one loss, playing in the finals. Certainly in the Final Four, we would see that. Anyway, I have a second segment here where I pulled an article I think has some personal insights that may be value to you. So let's go look at that. As with any article we bring to you from the internet in a status chat, you can find the link to that article in the description of the status chat on the YouTube site. This is from Real Simple, Mia Taylor, December 2, 2021. Her headline reads, 2 factors that may impact the real estate market in 2022. 2021 was certainly a wild ride for real estate, and 2022 may have some new realities in store, including increasing interest rates and competition from foreign investors. Let's see what else she has to say here. She says, it is no secret that 2021 has been a hot year for the real estate market. Houses are selling at record prices, bidding wars are frequently taking place for the limited inventory available, and it is not unusual for buyers to pay for home purchases entirely in cash. And she repeats her 2 points there on the bullets. Let's see about the Feds announce. Feds announce an end to the pandemic-era stimulus measure. In early November, the Federal Reserve announced plans to taper off its $120 billion bond buying program and begin winding down its historic efforts to stabilize the U.S. economy amid the roller coaster ride of COVID-19. Well, we have certainly been printing tons of money, and that has caused multi-decade high rates of inflation, and we're going to pay for that. I'll speak to that where she does not. Now, slide down to here where she quotes a person named Mermelstein. Currently, mortgage rates are between 2.5% to 3%. So an increase in 0.25% would increase your monthly expenses by 20%, which is significant. Therefore, it is always best to buy now instead of 6 months from now, Mermelstein continues. Well, that does sound a little bit real estate-y, but the truth is we've got decades high inflation caused by the printing of the money. And that's going to come back to bite us. Historically speaking, the way we combat high inflation is with high interest rates. And in this article, they're only talking about going up 0.25%. But that's not where you really get kicked in the teeth. Everything is going up, outpacing wages. And it's just that simple. When you have less wages for the things you need to buy, you actually lose your buying power. Now, when houses are at record highs, it means it's going to be record highs to rebuild them and replace them, as well as build new ones. So fully expect your insurance rates to go up. Fully expect your interest rates to go up. And as the price of the home itself goes up, expect your principal to go up. So we have this thing we talk about, PITI, which is principal, interest, taxes, and insurance. Now, we know that when the home value goes up, your taxes go up if they don't even increase the rate. So expect all of that to go higher and higher while your energy costs are going through the roof, your food costs are going through the roof. All of these are increased things you really need to live. And if you spend more on your cars and tires and gas and heating and all that other stuff, that means there's less and less available to go to your mortgage, which is just one component of those 4 things, those PITI, that we know is going to go higher. So, I want to slide on down to this point where she mentions Redfin report. Now, Redfin is one of the iBuyers. Now, iBuyer is an instant buyer, they call them. I like to think of them as internet buyers because basically they convince an individual to sell a home directly to them by using the internet to do so. They make you an offer, you go out and you say, oh, this looks great, we buy that. They buy your house. What they're buying your house not to live in, they're buying it as inventory for resale. So when they resell your home at a profit, they're actually they're also building the history that supports higher home sales prices. And they are a business, so they have their own investors. So is Opendoor and the others. So to me, I don't know that the foreign investment, her argument for foreign investment being increasing in 2022 makes any sense quite a bit when we have our own American investors, when we have these major iBuyers raising prices by virtue of the purpose of resale. They're buying inventory for resale. And she makes this point later on that the borders are open and that has an effect on it. Again, I didn't realize that the borders open or close really clamped off international business. Now, Redfin report, which she quotes from, says the median home prices have increased 13% year over year to $357,881 by last month. They were up 30% from the same period in 2019. Well, if we start spanning larger and larger time frame, more and more years, we're going to get a greater percent in home value increases. Now, we're going to jump down here to the foreign investment returns. And she says because the nation's borders were largely closed during much of the pandemic, the housing market was essentially protected from even bigger run-up in purchase price that may have been driven from foreign investors dabbling in the market. I don't know that I agree that that's an actual valid point. But we're going to jump on down to this right here. With the advent of the Omicron strain, or if you're British, Omicron, the Omicron strain of COVID, I think a lot of bets are up in the air. If it is not off, says Ellen Sykes, broker with Wahlberg Realty. Well, it's certainly an unknown, but at this point in time, I think the bulk of the world and the United States are just tired of hearing about that, about COVID. And the doctor I heard on WTN Nashville, and she says it's really nothing right now. It may be something, but right now it's next to nothing. But we're hearing people mention it as if it's going to be the next COVID. That response is a lot of federal money getting printed up. Now, the takeaway from home buyers, she says, the experts at Opendoor continue to predict the spring of 22 home buying season will see high demands across the United States despite any potential market changes looming. Well, Opendoor is another iBuyer. They're another investment buyer who buys your home for resale. So anyway, that's what that little article has to say. I do want to bring to you my twist on this article, that we have PITI, the principal, interest, taxes, and insurance, and I see all of them going up as a result of this wild printing of money. The roosters are coming home to roost. We're going to have to pay for all that, and that's all it really boils down to. As houses get more expensive to build and replace, your insurance is certainly going to go up. Your rates are going to go up because we have to combat the decades high inflation. So your principal is going up, your interest is going up, your insurance is going up, and as the value of your home goes up, so will your taxes in all probability. So it really is a good time. If you're looking to buy, call me. Let's see if we can get something going for you and find you something that you'll like right now so that we can get that up and get that off the plate for 2022, or certainly the first half of 2022. So you know how to find me. Call me. I'm here. Hello, I'm Dale Delbridge of Benchmark Realty, Murfreesboro, Tennessee. If you are currently unrepresented and would like to know how to compare up to 3 properties side by side and room by room, then go over to my new YouTube channel. Call Dale to Sell. That's one L in Dale, no spaces. Watch the demo on Real Scout and then call me and we'll set up your exclusive ad-free account today. Now that we have that out of the way, let's look at the numbers here from the previous week. We had 94.70 in the opportunities, which was down over the previous week. We had 46.39 down over the previous week with a ratio of 49%. This week we have 94.23 opportunities and we have 44.26 in the under contract still showing. Both of those numbers continue downward, and we had a 47% ratio between them, which also trailed down. We appreciate you watching. It's time to sell. Call Dell.